The Gravity of Money, the Hidden Architecture of Dollar Dominance. Section 1. Thesis. The modern dollar system is not held together primarily by trade settlement or commodity pricing, but by global willingness to store long-duration savings inside dollar-denominated sovereign liabilities. Transactional usage creates velocity, but reserve demand creates gravity. And as confidence in fiat debt weakens, the world slowly begins diversifying toward harder, less dilutable stores of value, reshaping the architecture of global monetary power. This is not a story of imminent collapse. It is a structural reconfiguration. Rising sovereign bond yields across major economies signal eroding demand for government paper as a reliable parking spot for surplus savings. Central banks are responding with accelerated gold accumulation. The layered mechanics of money, store of value, unit of account, and medium of exchange, reveal why the fixed income vault is leaking and what the destination looks like, a hybrid multipolar store of value regime. Section 2. The three layers of money. Money performs three primary functions. The textbook list sometimes adds a fourth, standard of deferred payment, but that role is derivative, not foundational. Store of value, the ability to hold purchasing power reliably over time. This is the gravity layer, where surpluses from trade, energy, and productivity are parked for the long term. Unit of account, a stable measuring stick for pricing goods, services, debts, and assets. Medium of exchange, the lubricant for transactions, eliminating barter. Deferred payment, including loans, bonds, and futures, depends primarily on store of value stability. Lenders must trust that the principal will retain real value and that interest will compensate for opportunity cost. Without credible store of value, long-duration credit markets become dysfunctional, exactly what higher-term premia and volatile yield curves are beginning to reflect today. The refinement that unlocks clarity is splitting the store of value layer itself into two vaults. Fixed income vault, government treasuries, treasury bills, corporate bonds, agency debt, and money market instruments. This is the traditional home for official reserves and institutional savings. Growth vault, equities, venture capital, and growth-oriented risk assets. This is more private sector driven, but still recycles global surpluses into dollar-denominated claims. Store of value is where the real power resides. The unit of account and medium of exchange functions are largely pass-through, temporary exposures needed for oil, gold, or trade settlement that can be converted out quickly. Section 3. The hidden engine of dollar dominance, velocity versus gravity. Most commentary fixates on the visible plumbing, dollars used in oil invoicing, SWIFT messages, or daily foreign exchange turnover, with the United States dollar still on one side of roughly 89% of global trades. These matter, but they are velocity, money moving through the system. The true gravitational center is capital storage. Global surpluses, from German export earnings, Chinese manufacturing profits, or Gulf oil revenues, need a deep, liquid, trusted place to rest. For decades, that place has been dollar assets. Foreign holders own roughly $9.5 trillion in United States treasuries. This demand finances chronic United States deficits cheaply, enabling the exorbitant privilege of printing the world's reserve currency while running large imbalances. Post-Bretton Woods, after 1971, the dollar lost its gold anchor and became asset demand-backed. The system's durability relies on continuous global appetite for treasuries, dollar bonds, and United States equities. This recycling loop, surpluses flowing into dollar assets, then into United States deficit financing, then creating more global dollars, sustained the architecture. The decisive insight is this. Transactional usage is pass-through and relatively sticky due to network effects and liquidity, but store of value demand is the structural anchor. When confidence in the fixed income vault erodes, the gravity that holds everything together begins to weaken. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. The fixed income vault is leaking. Current market signals confirm the pressure. As of mid-May 2026, United States 10-year Treasury yield roughly 4.46 to 4.47%. Germany 10-year Bund roughly 3.04 to 3.08%. United Kingdom 10-year Gilt roughly 5.05 to 5.11%. Japan 10-year government bond, roughly 2.54 to 2.63%, representing multi-decade highs. Higher yields mean lower bond prices. Markets are demanding greater compensation for holding long-duration government liabilities. This repricing reflects public debt burdens. United States debt held by the public crossed 100% of gross domestic product in early 2026, with approximately $31.27 trillion of debt versus roughly $31.22 trillion of gross domestic product. Gross federal debt exceeds 122%. Unsustainable fiscal math. Annual deficits near $1.9 trillion. Net interest payments now rival or exceed defense spending and crowd out other priorities. Inflation and energy shocks. Oil above $100 per barrel adds persistent pressure. The United States dollar share of global allocated reserves has fallen to roughly 56.8% in fourth quarter 2025 data, the lowest in decades. Central banks are not abandoning dollar transactions overnight, but they are diversifying the parking function. The clearest signal is gold. In first quarter 2026 alone, central banks bought a net 244 tons, up 17% quarter over quarter, led by Poland with 31 tons and Uzbekistan with 25 tons. Full year 2026 projections remain between 800 and 900 plus tons. For the first time in modern history, central bank gold holdings, approximately $4 trillion, now exceed official United States Treasury holdings in total value. This is not tactical hedging. It is strategic store of value rotation away from dilutable fiat debt toward a neutral, non-sanctionable, inflation-resistant asset. Section 5. The multipolar transition. The destination is neither dollar collapse nor smooth continuity. It is a hybrid multipolar store of value regime. Gradual reserve fragmentation. Gold and bilateral arrangements gain share. The United States dollar remains dominant, but no longer monopolistic. Harder anchors. Commodities, strategic reserves, and regional systems supplement fiat liabilities. Persistent unit of account and medium of exchange stickiness. Dollars are still needed for many spot transactions, but at higher cost and with more alternatives, including China's cross-border interbank payment system, local currency deals, and BRICS experiments. Elevated borrowing costs globally. Weaker gravity means higher term premia, steeper curves, and tighter fiscal discipline for everyone, including the United States. This transition aligns with historical patterns, including sterling's long decline. It unfolds in phases. Store of value diversification first, then bilateral trade experimentation, then parallel infrastructure. Geopolitical fragmentation, sanctions, energy wars, and supply chain resilience accelerate the process. Network effects, legal infrastructure, and derivative depth still favor the dollar, but those advantages rest on the foundation of credible store of value. When that foundation cracks, everything else drifts. Section 6. Conclusion. The transactional layer is velocity. The store of value layer is gravity. Velocity moves through the system. Gravity holds the system together. As global willingness to store long-duration savings inside fiat sovereign liabilities erodes, visible in rising yields, record gold buying, and fiscal strain, the hidden architecture of dollar dominance is shifting. This is not panic. It is realism. Nations and markets are quietly repositioning for a world where monetary gravity is distributed more broadly across harder assets and diversified poles. The framework clarifies the stakes. Attack or defend the store of value branch first, because that is where the real power and vulnerability resides. The current turmoil is not noise. It is the sound of gravity slowly realigning.